Finally, we got the result from the Kevin Warsh's first FOMC meeting. First, the Fed kept interest rate unchanged, just as the market expected. There was no dissent. Every voting member agreed with the decisions. But when we look at the dot plot, Fed officials now seem to expect one rate hike by the end of the 2026 this year. So on the surface, this meeting may look tough on inflation, but I think the more important point was not just as the higher rate path. The bigger point was the change in how the Fed talks to the market. Warsh did not put his own dot on the dot plot. The Fed statement was cut almost in half, and the Fed removed a lot of its policy hint during the press conference. Warsh moved back and forth between a tough message and a soft message. So today we're going to talk about what we learned from the first FOMC meeting under the new Fed chair, where the Fed may be heading, and how investors should think about this new Fed style. Before we start, I post the global market news every morning on my YouTube Shorts. I strongly believe this will help your investment decisions, so please check that out and subscribe to the channel so you don't miss any of them. Okay, then let's get started. So why did Warsh change the Fed's communication style? To understand this, we first need to understand how Warsh looks at the market. His view is simple. Market prices should be created by millions of people looking at the economy and making their own decisions. Each person reads data, puts money at risk, and makes a bet. Then all those choices sum together and create a fair market price. In other words, market prices should come from the wisdom of crowd. That is the basic reason why the market exists. A market should be able to find order by itself without one person or one group telling everyone what to do. But today, markets do not always work that way. Instead of asking what does this data mean for the economy, investors often ask how will the Fed react to this data. That changes everything. Prices no longer reflect only the economy, they start to reflect what investors think the Fed will say or do next. So market prices become like a mirror of the Fed's own voice. And that is where the real problem begins. The Fed also looks at the market prices when it makes policy decisions. But if those market prices are already shaped by the Fed's own board, then the Fed is looking at the data that it already influenced. It is almost like an echo. The Fed says something, the market reacts. Then the Fed looks at the market reaction and uses it as information. Warsh seems to worry about exactly this problem. So his solution is simple but very important. He wants to take the Fed's voice out of the market as much as possible. That means fewer hints, less forward guidance, and shorter statement. If the Fed talks less, the market has to go back to the real data: company earnings, inflation, supply and demand, credit condition, and the real economy. Walsh wants the market to stop watching the Fed's mouth and start reading the data again. So when the Fed reduces guidance, it is not just a small change in style, it is attempting to bring back the market's own price discovery function. But from the market's point of view, this may not feel comfortable. For many years, investors were used to getting hints from the Fed. Now, those hints may suddenly disappear. When the guide disappears, it becomes harder to guess the next move. And when it becomes harder to guess, market swings can become bigger. This style also has one clear weakness. When markets are calm, it may be fine, but when markets become unstable, the story can change. If the Fed does not show its thinking clearly, investors have to guess how the Fed sees growth, inflation, and jobs. Then the gap between what the market expects and what the Fed actually does can become wider. And if Walsh wants to surprise the market on purpose, the risk can become even bigger. Some people believe monetary policy works best when the market does not fully expect it. So if Walsh moves rate against market expectations, short-term market swings could become much larger. This means one thing for investors. Going forward, it will become more important to read macro data, understand the inflation trend, and guess the Fed's reaction without depending too much on Fed guidance. Now, let's look at the dot plot. For 2026, Fed officials were split exactly in half. 9 officials expected at least one rate hike, the other 9 expected either no hike or rate cut. So the median barely landed on one rate hike. But there is the key point. Warsh's star was not included in those 18 dots. If Warsh had submitted his own dot, the result could be changed. Therefore, the headline number one rate hike may have been created partly because Warsh chose not to submit his own dot. In a way, he kept the balance very carefully. Now, let's look at the economic projection, also known as SCP. Growth and unemployment did not change that much, but inflation is the part we need to watch. The headline inflation forecast moved higher, but much of that seems to come from the energy shock in the Middle East. The Fed can look at that as a temporary supply shock. So, what really pushed the future rate path higher? It was the increase in core inflation forecast. Core inflation removes energy and food, so it shows the more sticky part of inflation. That means Fed officials are still worried about deeper inflation pressure. Another interesting point is the wide gap in the 2027 and 2028 dot plot. This tells us Fed officials do not fully agree on the long-term path of the economy. Even for the 2028 dot plot, not only Walsh but other officials did not submit a projection. So even inside the Fed, there seems to be no strong confidence about the long-term direction. Now, what can we learn from this FOMC meeting? The biggest message is this. Walsh is trying to break the old habit where the Fed coaches the market. He wants to reduce the Fed's role in financial market and make investors focus more on data. The market may not like this at first, or it may slowly adjust to the new style. However, financial markets are very good at adapting, so we need to watch how investors respond over time. Overall, this FOMC meeting can be seen as tough in the short term, but I do not think it was extremely tight because the long term neutral rate stayed at the same. The Fed may be pointing to one rate hike in the near term, but the final destination did not move higher. That is very important. We also need to see current market with two different cases. One case is 1997 style insurance hike. One hike to control risk, and then the Fed goes back to the normal path. The other case, the other case is 1999 to 2000 style rate hike cycle. The Fed keeps raising rates again and again. Based on this meeting, the Fed is still closer to the 1997 case. They show one hike this year, then rate cut again in 2027 and 2028. Also, the final destination is still around 3.1%. So the basic Fed view seems to this: raise once, then return to the previous path. But there is one trigger that could change the story from 1997 to 1999. That trigger is the supply delay Walsh talked about. If the supply side takes much longer to improve and demand keeps running ahead of supply, then inflation could stay strong. And if the long-term data finally start to move higher at a future meeting, that would be much more serious warning sign. So what should we monitor from here? First, we need to watch the next core PCE report. If core inflation peak and slowly come down or it stays sticky. Second, we need to watch inflation expectations. Third, we need to track economic data and see how the market prices the chance of a rate hike in October or December to confirm if only one rate hikes or starting a new rate hike cycle. Fourth, we need to watch the long-term dot in the September dot plot. If the final dot moves higher, the story could change. So today, we look at the result of the FOMC meeting. This was Walsh's first major move as a Fed chair. He did not put his own dot on the dot plot. He removes many policy hints. He made the statement shorter, and he said the Fed will create more task forces. So for now, investors are in a new environment. We have to keep guessing what Walsh really wants. The Fed may talk less and the market will become harder to forecast. That is why we need to follow the data more carefully from now on. Thank you for watching until the end. If this analysis was helpful, please hit the like and subscribe to the channel. I'll see you in the next video. Thank you.